A warm good evening to all the participants. By SEBI and AMFI definition, large caps are top 100 companies on the market cap, and next 150 companies are classified as mid caps. Out of approximately 5,000 listed companies, 4,750 are classified as small and micro cap. While large caps are synonymous with our daily life, from Hindustan Unilever to Maruti Suzuki to HDFC Bank, and we use the products and services of all these large cap companies. While mid cap are little lesser known than the large caps, the small cap names are mostly alien to us. While universe of small cap is very large, stock picking becomes an art and science. And we have a fund house, Care PMS, who have mastered this art of stock picking in the small cap space. Over a decade, they have delivered 22% CAGR since inception. To present the strategy, we have two distinguished gentlemen who is going to join on behalf of Care PMS. First is Arpit Shah, an entrepreneur by nature, is co-founder and member of investment team of Care Portfolio Managers Private Limited. Arpit brings in 15 years of experience in the capital market. He has contributed articles, views to leading newspapers, newsletters, and made presentations on equity markets as a speaker in different platforms. Care PMS has managed over 500 crores of AUM through its two strategies. The flagship strategy being Care PMS Growth Plus Value is going to be presented today by Arpit Shah. Arpit Shah is joined by Mr. Vishal Shah, who is a director in Care PMS with about 20 years of experience in the capital market. He heads business development and client relationship, is instrumental in scaling up operations for Care PMS. Now, if I hand over the stage to Arpit Shah to make the presentation. Over to you, Mr. Arpit.
Thank you very much, Mr. Sivaram. Welcome, friends, and particularly thanks to PMS Bazaar for giving us this opportunity to share with you what all opportunities are available beyond top 250 opportunities, beyond top 250 companies. After 3 days of green, I think most of the anxiety of what will happen to world has little bit calmed down. Before I take you through this presentation, a quick brainstorming question. If we want to deploy your funds, if you have to deploy your funds, which three companies pops in your mind? In last 4 months, all the companies, irrespective of the market cap or irrespective of the industry, has seen the selling pressure. More so in the large cap, but of course, mid cap, small cap has also come down. But if you want to buy, if you want to start afresh, which three companies comes into your mind? Okay, so based on our experience of last more than 10 years, out of three companies, most likely, yeah, Reliance, TCS, yes, I can see all the names. So out of three companies, most ICICI Bank, I can see people are replying HDFC, City Gas Distribution Companies, okay, that is good. So I normally what happens that why these two out of 250 companies opportunities doesn't strike first in our mind. So today's presentation is all about how one should look beyond opportunities, beyond top 250 companies, and what are the opportunities. Okay. Today I will the flow of the action, flow of the today's webinar is the first I will uh, do some fact checks about the performance of small cap companies. What are the myths that that is there in this when we think about small cap companies? What are the risk and reward in this segment, and how Care PMS strategy can help an investor to participate in these opportunities? So before I take you through the presentation, just a small disclosure that I together with my company and my clients may be having direct or indirect exposure to the companies that we discussed during the presentation. This presentation is mainly for the education purpose. So let us understand the basket, broader basket. Like Mr. Sivaraman said, that we have more than 5,000 companies, around 5,000 companies in the listed space. Only 10% of the companies, okay, that has more than 10,000 crores of market cap. So top 250 companies has falls under this, and their size, number of companies is significantly lower when you have 90% of the opportunities available outside. So uh, uh, there are two major reasons why this is not followed very stringently. One of the reason is funds available, because we have more exposure to the large cap funds, mid cap funds. So funds itself is available very small in size. And second, there are some myths. Both the questions we can address in the later part of the slide. Personal level पर I am very much impressed with the strategy called blue ocean strategy. It is This strategy is describing a big ocean in it separates two ocean into separate parts. One is red ocean, another is blue ocean. In red ocean, industry boundaries are defined and accepted. In top 250 companies, I think majority of we know that these are the financial sectors. These are this much weight has to be in the financial sector, and vice versa. The competitive rules of the game are also known. Product becomes commodity. In top 250, I think majority of us are thinking about we are okay for 100 and 200 basis points of difference in the performance, but our focus is more when we are employ some fund manager. Our focus is more on the fees side instead of the outperformance. Uh, but I personally feel at the same time, I personally feel that you may not need a very big fund manager. If you invest into through mutual fund, you can make reasonably good money if you want to stick to that basket. However, blue ocean is described as an analogy to describe the wider, deeper, and potential to be found in unexplored market space. Why it is unexplored, I will explain you in the later part of the presentation. A blue ocean is a wide, deep, and powerful in terms of profitable growth. But there is a fix in the market. In the market, when you go beyond 250 companies, you have to have that kind of skill set, that type of intellect, and that particular type of temperament, which will help you to sail through these small cap companies. Now let us see what has been growth in last 10 years in small cap segment and in large cap segment. So if you can see this company, we have taken top 1,000 companies by market cap in last 10 years. So during this period, there are 21% of the companies, even with the larger basket, there are 21% companies who has delivered more than 10x returns, whose market price has moved 10x in 10 years, while only 9% of the companies are giving more than 10 times return. At the same time, if we check for the negative returns, there are more or less similar. So in both the segment, whether when we call small cap as a risky, okay, at the even large cap, there are 26% of the company who has given negative return, or they uh, into losses, and at the same time there are around 21% companies who are into small cap and get delivered negative return. So if so this is please have to we have to keep in mind that this is a wider basket. We are selecting from 250 companies 9, and while in 750 companies 20%. So bigger basket but bigger opportunities. Now if we narrow down last 21 performance, let us see what is happening. Why I'm taking this 21 months, that I will explain you in just a while. In last 21 months, total total money made around 30 around 30% companies have in the small cap category have delivered more than 4 times return. Okay, if we combine 4x and 10x, so around 30% of the companies have delivered more than 4x returns, while in the large cap it was hardly 10% of the companies. And the again in the same slide, if you look at the negative returns, so there are more or less same. So if I have to claim, I have to say a statement that risk in both the segment is similar, risk of pricing going down. Now, why I have taken this last 21 months target is because post-COVID, what we are observing, we can move to the next one. What we are observing that there is low cost funds are available. This there are structural changes which will benefit not last 21 months, but which will benefit for at least foreseeable future. For next 4 5 years, what we expect that this low cost funds will be available in the market. There will be value rating when you pay 100x 100 times of earning to a large FMCG, and the same segment smaller companies available at say 10 20 P, then there is a valuation re-rating should happen. Good number of retail participation has happened so that funds are available for the small cap companies. Revival of the capex cycle and unprecedented enthusiasm of the Indian entrepreneur. So these factors will certainly take Indian economy and our small cap segment for the better future. And that's why we have taken this shorter cycle. So we believe that this past 21 months of outperformance can be repeated for foreseeable future. Now, if we take, well, let us understand whether this 10x returns has been backed by the fundamentals. So answer is no. There are only 1% or maybe you can say 7% of the companies in last 10 years whose top line has grown significantly 4 times. However, on the risk side, on the negative side, there are 36% of the companies who has shown the negative return, a negative growth on the financial side, on the revenue side. Let us understand whether PAT reflects any growth or no. In the PAT side also, on the profit after tax, somewhat similar has happened, but there is one check. So, profitability has improved. Around 20% of the companies have improved the PAT figure, while compared to around 15% in the large cap. While when I say large cap, it means I mean large and mid cap, both the segment. My major focus is on the small cap. So this is, you have to understand. So, and on the negative side, there are 50% companies whose profit has been wiped off in last 10 years. And they may have fallen from the small cap to micro cap. Okay. So only what I want to communicate here is that on the chart, it looks like that small cap are making money. In real life, you certainly will need a skill to spot the opportunity. You will have to be very active to remain passive investor while you invest into small cap companies. While why we invest into market, yeah, when it is simple answer is to make money. Yeah, we know where we are making money. We are making money from the small cap segment. But what are the things that we have to keep in mind while we invest into small cap segment? What are the opportunities are there? Okay, and what are the risks associated were there? So that I will take through the in the next slide of the myths. Through this data of the fact checks, previous data about the revenue, about the PAT, and how the market has behaved, I have explained why one need to look beyond top 250 companies for making money. And for now, we go back to the original question of the myths, right? Why there were in the midst, we start with the same question. Why we share that name ICICI Bank, Reliance, TCS as the top three companies first that we will be investing? It is because we believe that may small cap inherent certain problem. What are those problems? So first, let us understand the small cap prices. We have in our mind that small cap prices are managed. So it's not so. It's not easy. It may be partly true, but we are much more protected nowadays from the regulator and even from the perspective of the manager, from the company's perspective. uh, all small cap companies are not punter stocks. That's what, whenever we share any unknown name to the clients or to the investor, it's all, yeah, ye to punter stock hai. Why? Because they have not heard of the name. but it is not that. Also, it is not managed by. It is not the pricings are not managed. Regulator has played its own role very well. Like we have 100% promoters shares into demat form, so we know the movement. Disclosure has been become very stringent when you have that compulsory pledging data and other data is shared by the promoter. At the company's point also, companies are becoming more professional. They are many companies are going from the promoter driven to the professional driven company. There are regular analysts made, there are regular information is available. So it is blessings in disguise, all the digitization, and that's why small cap is perfectly transfer. It is market price of the small cap is not manageable. It is not that all the companies are works on the merits at the end. On the second slide, second myth is the small cap or small business. Here one point, but the data shows the other way. 51% of the small cap companies has more than 1,000 crores of the revenue. Okay, this is significant. When you have 1,000 crore plus revenue, you feel that these are the known brands. Like Sivaram said in the opening remark that we have heard of Colgate and NBFC, but of course we use the MRF, we use that maybe into mid cap, but we may be using Dawat rice, we may be using India Gate basmati rice that falls into small cap companies, but their revenue is more than 1,000 crores, some 4,000 crores, some 5,000 crores. So these are big players. 40% of the small cap companies has more than 100 crores of PAT. That is also significant. After tax also you have 100 crores of cash surplus. Together with the depreciation, it will be added to that. So these are not the small business. They have significant market share. They have significant revenue. They have significant financial positions. 82% of the companies in the small cap has is less than one of the debt to equity ratio. This is a weighted average. So maybe some companies may be having higher weightage, and of course NBFC we have excluded from this list. So this is here one point I have to one point I have to emphasize is that it can be considered as a lower float available in the market, but that matters when you want to put very large chunk into particular company, then probably the float may make the difference. But we have covered that also, how we can mitigate through this. And so these are the significant players. So let's go to the next point here, why one should look beyond 250 company. So we have to ask few questions to ourselves. First, whether these top 250 companies represents all the sector in the economy. The answer is no. The second question is, if we want to play any macro theme, okay, like we played in ethanol, or I will share that data in later part. But if we want to play some macro themes, do we have the options available in top 250 companies? So answer is no. If we look at the say auto ancillary, there are only two companies available in top 250, and beyond 250 there are 36 options available. Similarly, chemical was the best performing industry in last decade. There were more opportunities beyond top 250 companies, and only five in the chemicals, almost seven times. Textile, which is the currently considered to be the best option for investment because of the China plus one policy, because of the raw material yarn price and many other things. Europe, EU, the treaty that we are going to sign. There are 33 options available beyond 250. So you see the wider basket gives you more opportunity, but you have to put your efforts. You have to understand. You have to understand financial and also unique businesses. You will be able to identify only into this small cap. You will not find a dedicated EV player in the large cap. You will have to go beyond top 250 companies if you want to play only single role of EV company, single product company which is into EV. I can share one example of say multiplex. Okay, in China there are around 80,000 multiplexes. In US there are 60,000 multiplexes. It is India at the same time we have only 10,000 multiplexes. When if you want to grow, if we see that okay this can be the next trend, both the options PV are only two listed players, and both the options are available in the small cap category. So the only point I wanted to highlight is that this top 250 does not represent the complete economy, and top 250 uh, may not help you to play the macro theme. Which macro themes we played in last few years? Let me share some example. In 2013, we wanted to play chemical, understanding that okay, India can become a chemical hub. There were only 9 options available in top 250. In next 750, it was 145 options were available. In 2018, when sugar companies were having worst of the time, we wanted to play ethanol story because India was following the Brazil for the ethanol story. There was not a single option available to play. Uh, while in the next 750, all the sugar companies were falling into small cap category. Recently, when we want to play a textile story, when you know that okay, the macro things are happening, China plus one strategy is doing well, PLI scheme is going to come, you have a EU treaty, Europe business and US businessmen are looking to look beyond the China. Then, if we search for the options, we have only one option in top 250 companies, and next 750 we have 90 options. So these are such a big basket, and then we go and ignore. So if you miss this segment of small cap, you are likely to miss the macro changes. That is one of the message we want to communicate. Next slide is about how the since small cap index formed in 2000 in 2003, I think. Okay, yeah, 2003. How it has behaved. Here I will take your 2-3 minutes. So eventually you see at the end of February it has given CAGR of 21%, which makes your money multiplied by 35 times, while Sensex has given only 17% return, and it is only half of what small cap has delivered. However, there are few points if I can share during 2008, 2013, or in 2018. Okay, when you see a significant drawdown in the small cap index, and at that point of time, when your portfolio is down by 40%, 50%, you may feel that what is the matter? Yeah, why should I take such a risk? Why should I take such a risk for the because returns are similar, returns are same, but all this period, if you observe, the small cap has always outperformed. And if you give some more time, at 2000 in say March 2018, you feel यार अभी मुझे risk लेना ही नहीं है. I want to go to and stick to large player. I have seen many fund managers who wanted to focus only on the large cap companies because this is vertical fall was unacceptable and unexpected. So why to take this such risk? But if you gave another 6 months or another say after 21 months, what is the picture? Picture is there is a sky difference. So only what I want to point from here, I want to say is that you have to accept that was, this segment is, and this segment will remain high volatile. But that volatility does not mean it's a risky. Okay, that is the last myth I wanted to explain you. Chart we have shown earlier are depicting the same percentage of companies that gave negative returns. If you remember the revenue growth, PAT growth, or the market price fall. So there were market price fall in the shorter period and longer period. Number of companies were percentage of the companies were the same. However, if you have longer period of time, returns in the small cap would be phenomenal. It can be phenomenal. That brings me to express few traits of fund manager and retail investor. As a fund manager, what we see, how we see a particular situation versus a retail investor, because we are into, we now have decade of experience. We have seen many clients coming in and moving out. When there is a sharp fall, we have seen. I can share some example. Like we have seen a companies going down to 20% of our purchase cost. Thirumalai Chemical, we bought somewhere around at average price of 150. It went down to 30 rupees. We were holding, we were asking client to add the funds, but there were people who thought that okay, because this was a 40 years old company, this was exceptional situation, but we thought this is an opportunity to own more, while at the same time many of the clients were panicked and exited. And same thing happens for number of years. It happens always. It is not for the first time. It has always happened. We have seen this in many times in the past. When we see the profit booking, of course, we see when business growth deteriorates, while retail investor normally books profit when it moves out. So if you are holding a company to 80% at 80% loss, you at least give time to at least double, more than double. You should expect the return. That is the logical thing to have the risk reward ratio in mind. But price moves up, that keep booking the profit and they hold into the losses. Portfolio weightage, of course, it matters the most, and that's where a role of a fund manager may play a larger role. And around 20 companies, we try to balance the portfolio, we try to balance the risk and reward, while it is most likely that retail investor is exposed to the fewer companies. So in portfolios, we have seen while evaluating that some of the retail investors has 80% weightage in three companies because that has only delivered good return. Why all the companies are negative? In a nutshell, what we believe is that retail investor, the only decision making factor is price, and price. And as a fund manager, it is about business, business, and business. So when you have focus on the business, okay, so your decision and thought process would be different than on the price. So I conclude my this part of the presentation where I explain why one should look beyond top 250 companies. Before I take you through the about Care PMS, let me reiterate that there are huge opportunities available in the market beyond 250 companies for next few years, provided you know the business and ready to see the price volatility. Repeating my slide earlier, that long-term macro benefits are uh, economy is going to flourish. There are excellent opportunities beyond top to 50 companies. You have to be vigilant. There are opportunities which will be available only beyond top to 50 companies, like China plus one policy. Textile is one of the best example. If you know, if you read newspaper, you know that many small cap companies has applied for the PLI scheme and not the larger one. You will be you will get better focused company who can nowadays new age companies are coming up, so those options are available in the small cap. So better we look beyond top to 50 companies for the better returns. We are making investing into market to make more money, okay, but when we want to invest, first thing comes into our mind is the safety. And I have with figures I have expressed you that this is safety or risk on both the segment is the same. Then there is no point of having that safety mindset in place. Instead, you try for the company and go beyond top to 50 invest companies, invest and make money. So that's about the opportunities beyond top to 50 company. Uh, Let me now run through you about the Care PMS. We are Mumbai-based SEBI registered company, founded by four chartered accountants, including myself. Our current team is of 17 people, managing around 500 crores of funds. Our uniqueness is on the focus. Focus because we are dedicated to only one activity, which is PMS, which is reflecting on our performance. If you look at our performance chart, we have delivered 22% CAGR since inception. That is practically we have multiplied our clients' funds by 8 times. However, this this journey has not been in the linear curve. This does not give you a linear curve. If you look at the beginning of 2011-12, we have not made any money. Before 2017, there is a sharp upside, and then in 2000 till 2020, there was a sharp downfall, and then there is a sharp. But that is inherent in the small cap segment. You have to ready for the sharp vertical fall and rise. Today only we have seen one of our major holding is up around 10%. So that hardly happens in the large cap segment. Hardly, it never happens. I don't say it never happens, but it happens seldomly. But in small cap, पूरे साल का रिटर्न सिर्फ एक दिन में छूट जाता है. But you have to be patient for remaining invested. Now taking you to the next slide, where is our major exposure? So 72% of our exposure is into small cap. Again, going back to the myths, whether these small cap are really small. So what are our holdings? So we are holding one of the largest copier paper company in India, which has 24% market share. We are holding significant and most innovative player in the specialized packaging. We are having 7 decade old uh, company in the roofing solution who has the highest market share and highest margin since last 7 decades. So and so on and so forth. Significant player in the basmati player, oligopoly play, phthalic anhydride, ethanol blending, sugar, the most efficient player we are owning. So those are the significant garment export. Of course, there is the tiller tractor industry. The 50 tiller company that we are owning is having 54% of the market share. So these are virtually debt-free company, many of them, and these are large business, large companies, though it falls into small cap categories. So again, breaking the myth that small cap doesn't mean small businesses. In case in case studies, I will explain you about their financial, about their strength. Next slide depicts what is the thought process behind the selecting the stock. So as chart depicts, we are okay for both the bottom up and top down approach. Ethanol story that I explained you was a top down approach. We thought that this industry should do well, and we picked up the one of the sugar company. Similarly, we played before COVID. We played 2000 in 2019. We played pharma story where we wanted to have exposure, seeing the significant. There was a pharma companies were coming out of the woods, so we thought we should take some exposure. That was a top-down approach, and currently in the textile industry, we are looking even for small cap, mid cap IT companies, we are looking to as a top-down approach. However, the major exposure happens through bottom-up approach. Stock selection happens through bottom-up approach. When we select the company based on the research or event or quarterly results, then we back check their financials, prepare the projections wherever required, or most likely we meet the management to understand the potential, and then we take the investment decision. Um, uh, we are sector agnostic. We are also market cap agnostic, but we have certain restrictions, so we don't invest into particular set of companies like liquor, leather, or tobacco companies. We don't invest because all there are some religious uh, belief that, and we believe that we are partnering with the company by investment. In the stock selection criteria, the another of the how we select the company is specific at the micro level. So these all four has to be present. The company has to have a growth potential, company has to have a management, company good management, good corporate governance, very strong financials, and compelling values. Let me just to signify case by case, these all four has to be there, but for better understanding, I will just share few case studies based on taking only one of the aspect. Like in management, we we have investments into HIL. We are having investments since 2017. Okay, what we important, we were this company was on our radar, but it was very good valued company. Valuation was very cheap. Cash on the books was very good, but it was lacking the spirit of growth. When the new management came in 2017, Mr. Dhirup Roy Chaudhary, and in very first speech, he said that I am going for the diversification. I will be going for the I may be going for the acquisition, and my focus is growth. And we met them. We understood the how he is going to give the growth, and we invested into this company. During this, and of course, that figures and the chart it is showing. So how the management has played its role. If you see the revenue growth before and after, there is a stark difference, and so it is reflecting in the market price. Similarly, if we go talk about the financials, we have a JK paper, of course, run by the professional management, Mr. A.S. Mehta. There, the valuation was very good. Important part of the JK strength was their balance sheet. They have completed all their capex since 2014. Then balance sheet was becoming stronger. In the time of COVID, during the time of COVID, when you see that there is a shut of offices are closed, schools are closed, colleges are closed, Then also at that point of time, when other paper companies were struggling to for the revenue or margin, okay, this company had done 100 crores buyback. At the same time, they were having the largest market share, they were having the largest, highest margins per ton, and so on and so forth. So these are the financial strength where we buy the company. Another example, next term is the top-down approach. I explained you about the ethanol story. We bought Balrampur Chini. We played, all the companies have seen ups and downs. There were, there are, I think, for short of time, I will not be able to discuss each company in detail, but these are the macro themes which we played. Then there was a company of valuation point, Mastec. It was 30% of its market cap was available in cash. Okay, so for from our end, downside was protected. We thought that this is Mastec was the first listed company in Indian process from the IT sector. Before Infosys, Mastec was listed. So we were following the management. We knew that if something is going to happen with this much cash, there was a demerger of its one of the its subsidiary. So certainly something was going to happen, and rest is history. Turnaround also we play turnaround GoKex Google does export, when we show the change of the management and how actually management has turned around from loss making, it has turned around to the profit. And for too many things, though those were, it was not only due to numbers, there were, it was too much efforts were put into client relationship, into lowering the working capital cycle, into raising the funds. And we got convinced about this turnaround when we met the MD during the AGM in 2017. I'm assuming in 2017 AGM when we met the management, 2018. I'm sorry. It triggered us that okay, right now though management has to deliver what he's communicating, but we found that he's capable and he will do it, and then we have multiplied our funds. So, friend, these were the some few hits what I have shared with you. There were also some misses. There were, we are not 100% proof. There we have missed misses, like we lost monies in Bharat Electronics, BEL, NMDC, some companies like Asian Oilfield, Parag, where losses were in the range from 20% to 50%. But we booked the losses, we exited, and our portfolio returns is net of all these things. Even in today's portfolio, there will be few companies which may go down, which will certainly draw down the returns. But eventually, if I find one or two multi-baggers in the total portfolio, my returns will be exceptionally well. With this, I think the stock selection criteria I have completed. Now let me take you through the interesting part. Well, about the portfolio construction. Well, I see that there are too many analysts available in the market, and everyone is doing their own due diligence. Well, analysis is not a that big question when, but having how to apply that analysis into portfolio construction, I think that's where a dedicated or a focused or a professional management will play its role, like Care PMS. At Care PMS, we are a team of the people and not an individual. So Arpit Shah alone cannot take decisions of investments or divestment. We are team into, we have segregated two teams. One is research team, another is investment team. So all the decisions related to portfolio happens at the investment team. So at investment team, we discussed what are the companies that we have to select. We that will fall part of the portfolio. Typically, we have around 18 to 20 companies in the portfolio with a upper cap of around 12% in one company, 8 to 10 sectors with cap of 20% in one particular sector. That limitation on the particular sector and company I spoke about. And there is a regular, we are a team of 6 people into research and investment. So, we do regular monitoring and rebalancing the portfolio. About the exit strategy, because I think that is that is a question in many people's mind. Exit, we take the decision on the two bases. One is part exit or full exit. Part exit is somewhere when that threshold limit of the holding is arrived. So we have to exit, we have to book part profit. Similarly, when we feel that it is fairly valued or the growth may not be that much, then we may have part profit booking, or we want to have some more diversification. We want to add both the companies, a new company and the existing. Then may probably we book some part profit. Full exit, of course, the first is the business. If we find at any moment that business or conviction on which we have bought the company is wrong, we will have a complete exit, alternate of better options, or shift for the better company. Uh, what is our current portfolio looks like? So our existing portfolio, these are our top holdings. I think that has been shared on PMS Bazaar newsletter as well. And these are our industry sectors. Our average P is 24, top 5 holding. That is also 40%. That is also interesting because, having larger exposure into the high conviction stock is also a role of a fund manager. Okay, I can't be buyer. I can not play a defensive game of having, okay, everything is balanced and everything, too much diversification within 20 companies. Also I have a higher exposure to the particular company or to the particular sector. That is what is mentioned. Our average holding period is 4 years. This is also very much important. Reason being that we will not sell unless and until we are convinced that business is deteriorating. Okay, because market price may fluctuate. I shared details about the Thirumalai, but we don't mind having holding the company. The another maybe interesting chart is about the how we generate the cash, or what is our cash deployment strategy. So of course it is not very well defined. Right now we are fully invested. We have only hardly 1 or 2% of the cash available in the portfolio. However, in our decade of 1 decade of experience, we have understand, or we could identify euphoria or extreme pessimism in the market, and that's what is has been reflected in this chart. From last March 21, we gradually increase our cash to the 15% of the portfolio at the mostly at the peak of the small cap company. And then when market went into sideline or it saw some correction, we gradually deployed the company, and right now we are having only 2% cash available. So this is something, this is very interesting. We have learned while, remaining fully invested is one of our key criteria for the portfolio construction. This is something that really works well when you have the active fund manager. Okay. The key differentiator about Care PMS is, of course, single line of business, the performance, the biggest criteria. Then there is, diversification is there, concentration, diversification among the 20 companies, concentration on only high conviction stocks. So these are, it can be a customized portfolio manager. We don't follow any model portfolio here. So those are some key points of Care PMS, which I think which highlights what is the difference between what keeps us apart from the many of the fund managers. Having a professional team instead of a single fund manager is also giving us most subtle decision, helps us to take the good decisions. So friends, with this I conclude my discussion. Just key takeaways from this is small cap are not the small businesses. Returns are higher in long term if you remain invested. Investor play behavior plays very vital role, and certainly there is big opportunities is available at even today's market to for the next multi-bagger. And before that you need a you need to look beyond top 250 players and beyond maybe a fund manager. uh, thank you friends, and probably we can go for the question and answer. I'm sorry I took little more time, but I hope that presentation sounds well.
Arpit Shah, and in fact, two important points you have raised in the presentation has struck me. One is the scope and the choice of stocks in different sectors is definitely mind-boggling. And the second is when the drawdown happens, our retail client and our professional manager reacts. It's definitely a mind opener for me. Let us get into the question and answers. Before
Thank you.
we get into the question and answer, Mr. Arpit is joined by Mr. Vishal for the Q&A, and we have number of questions which has come, Arpit. Okay, and let us take the first question. Now, the long-term averages of mid and small cap is still expensive than the large caps historical long-term averages. In this scenario, how are you finding value in small caps?
So, in the small cap, you have to go with the stock specific. You can't play at index level. Number one. Okay. Second thing, large cap has seen a sharper selling because I think FIA has sold around 2 lakh crores of shares and they were having major exposure into large cap. But you have to ignore that index level P valuation thing. You have to go stock specific thing. Our average P is 24 at current price. If we discount the future, okay, then it is very much cheap, very reasonably priced. So we don't have to have any that prejudice of valuation at index level. We have to go stock specific.
Arpit, and we are joined by Paytm Money customers also. Some questions have come.
Yeah.
Lokesh Kumar Verma is asking, how many small caps should be held in a portfolio for a moderate risk, as mutual fund carries between 75 to 125 stocks, while your portfolio carries only about 20 concentrated businesses. For a risk mitigation, what should be the right approach to small caps?
So there are two things. One, that mutual fund size is very big. When you have 10,000 crores of company, you have to have the uh, larger number of companies. Okay, so they have to have. They can't have all the funds deploy in only 20 companies. For the retail investors, so how we construct the portfolio, we look at the growth plus value companies. Okay, so there are turnaround companies which may go, if go wrong, you may see a sharp drawdown in the portfolio. There are multi-baggers. There are value companies which are giving us stability. Okay, if this happens, then it will multiply. Otherwise, it will remain at this level. So at the time of construction of the portfolio, or at the time of constructing the portfolio, you will have to keep all these parameters in your mind. You can't have you cannot have the blind number of companies that okay, I will have 20 companies, I will have 15 companies. It has to be a combination of everything. You will need multi-bagger. At the same time, you will see value stocks. At the same time, you should be ready to take some risk of turnaround companies. So this portfolio has to be constructed in keeping all these things in mind. Vishal, if you want to add anything, do you want to add anything?
Yeah, broadly, the number of companies in a portfolio is very subjective term. Okay, broadly it identifies the risk appetite of a individual. Like if I look at a promoter of any company, okay, his major wealth is in a single company. Okay, and he is in and out aware of okay what is happening with his company, and he might be. I am 120% sure he may not be looking at a daily market price, okay, of his stock. Okay, but when it comes to an outside a promoter category, okay, and if you really want to make money, then you have to have a concentrated portfolio. Okay, and if you want to have a diversified portfolio, okay, then there are better products. Retail products are available like ETFs or mutual funds or that kind of thing. Okay, broadly, what Arpit has pointed out is we, as a fund manager, will look at the quality. Okay, and we believe that we want to restrict ourselves to 20 companies so that we can put a larger allocation to a set of companies. Okay, so when they will perform, okay, we generate alpha. If we diversify too much, then alpha generation will be again a tough task, and my returns might replicate the index returns.
And Dinesh Babu is asking, he's also a Paytm customer. And what is the biggest red flag for you when it comes to small cap? You have definitely told a list of items on which you exit a stock from the portfolio. What is the biggest red flag is what Dinesh Babu of Paytm wants to know.
So Of course, it will again be cannot be explained, at the at index level. It can be explained at the company level. When we exited from one oil exploring company, seismic study company, their largest contract got cancelled. It was from the government only, but it got cancelled, from which 50% of the revenue was about to come. So we exited with say 40% losses. Uh, One trigger psychological, one can say that when there is a euphoria, it is good time to book profit or sit on the cash on the small cap side. But euphoria, it is also very subjective. When we see that all the Tom, Dick and Harry वो चाय वाला भी आके बोल रहे हैं आपको okay okay sir ये shares ले लो. Okay, so that may be probably the time when you can look to book some profit or you have some exit. क्योंकि market में what will happen that you will always have a future guidance ready. So at what point of time, you have to discount that future. At what rate we want to discount. What is the risk reward ratio that you have to keep in mind, and that all are the red flag. It will be difficult to tell you what is the index level red flag. Company to company, it will be difficult. A company to company, I can explain you that NMDC was our bet on the revaluation, but revaluation was not happening, so we exited. So there was no red flag. Whatever financials were happening, that was as per expectation, but revaluation was not happening. Okay, so for all the company exit, there were different. In BEL, we thought that that there is a capital, there was a restriction on the margin. So based on which, on the financial what we were expecting, so we thought that okay, this financial will not be able to deliver, and we exited. So for company to company, it may differ, but at index level, on psychology side, you can say that euphoria can be one of the criteria to exit. And extreme pessimism, like we saw in the March 2020, that is the best time to invest money. I can share one example. If time permits, we were having around 600 clients in uh, around 600 in March 2020. We asked all our clients to add more funds. This is the best time. You will not get probably in next few years this type of opportunity. Out of 600, only two clients added the funds. So then when there is extreme pessimism, you should go and whatever beg, borrow, or steal, just put funds into the market, and particularly into small cap companies. And those two clients have made their portfolio, 4 times, 5 times.
The next question is any one of you, Vishal or Arpit, can take it. The strategic deployment creates alpha in small caps. Can you help us to understand what is your deployment strategy generally?
Broadly, we, as Arpit has rightly pointed out, as on today, we are fully invested. Okay. However, small cap as a basket or a growth plus value as a strategy. Okay, we do not follow any a model portfolio kind of concept. Like today, if someone is giving funds, okay, it will not happen that tomorrow everything will get deployed because I am already invested 100% in my existing clients. Okay, broadly what we do is we do a staggered manner, okay, for the new clients money considering the current volatile time. Okay, and again it is dynamic. Okay, so depend on the market situation when someone is starting. Okay, second, some deviation compared to other fund managers, like we don't buy anything and everything of an existing portfolio company at any price. Okay, so if today any company is not in my buying range, okay, even though I am invested the existing money, if it is not in my buying range or the price has moved up sharply, okay, I may give a skip for the time being in the new money. Okay, and I'll wait price to come down, or I may find some other opportunity. So that is something, a deviation which we do, okay, compared to most of the fund managers in India. Okay, and the existing strategy, if I can term on a deployment, if someone wants to start today with us, okay, we will take around 0 to 90 days to put entire money into the market.
Sure. Let us get into the next question. When will you decide to exit and stop on a bloated valuation, or your price target reaches, you will exit a stock? What is your exit strategy?
So broadly, we have covered the exit strategy. Okay, so one, of course, we are not a research seller. Okay, so my research will not come with a target price. Okay, like buy at 200 and exit at 300. No, it's a continuous monitoring process which goes behind a company. And as far as company continue to multiply their revenue, PAT, and fundamentally keep getting strengthened, and market is not overvaluing those companies, okay, we would like to stay invested in those companies. And in this journey of multiplication, I will do part profit booking. Okay, I will try to reduce my exposure if the value re-rating is already done. Okay, so it's a journey. Okay, there is no fixed target price on day one. Okay, when I want to exit, and we currently hold many companies which we are owning for more than 5 years. Okay, where money might have multiplied 10 times, and still I am buying at the new price. Okay, so yeah, so there is no fixed target price to exit. It's evolving, and we discussed that exit strategy in detail.
And at the same time, we don't have that stop loss policy also. Okay. So to exit, we don't need a price trigger to exit. Even if it is 40% down, business is not doing well, we will exit. And even if it prices are down 80%, but business is doing well, then probably we will hold. So everything, all decisions are based on the business and valuations.
The next question is, when a customer reaches the target corpus, how liquid is your portfolio for redemption?
Vishal, you can take this.
So broadly, the classic benefit of PMS as a structure for an investor is his kitty is separate from all other investors. Okay, so with our underlying investee companies and all, liquidity is never an issue for an individual investor. Okay, when he wants to exit, even in March 2020 kind of situation, if he wanted money, we could have liquidated a portfolio and given him the money back. Sometimes we may have some turnaround kind of companies or those kind of investment which has a limited exposure at overall portfolio level. There we might have to look at, if I need to exit all my positions, then it has to be a gradual exit, not a one day full exit. But yeah, at an individual level, that's a classic benefit of a PMS as a scheme. Okay, where his total segregation of investment is maintained. Okay, and in the current market or in a normal market, exiting a 500,000, 2,000 stock of worth, say 50 lakh to 2 to 5 crore is not a challenge at all.
And at the same time, Sivaram, what we have observed is, in the small cap, when there is a rise in the price, liquidity improves automatically. We can share many examples, probably, that when you see the only 5,000 shares are traded at particular price, but when price is multiplied by say 2x, 3x, then there is suddenly jump in the volume and it becomes 50,000, 60,000 shares a day. So I don't think liquidity is a problem.
Okay, okay.
And that is also one of the very critical aspect when we shortlist the company. If we don't get that float, we don't invest.
I got it. I got it. I hope the customer also, the investor has understood your answer. The superior, next question I'm getting into. The superior returns from your strategies is in a favorable market conditions and in a time where the commodity prices and inflation is hardened now. Generally, it is a general belief the small caps will be most affected in this kind of a high inflation and commodity prices getting hardened. How are you going to protect the returns which you have made already in your portfolios is what someone wants to know.
So there are two parts of the question. One is about the inflation, how the company can financial will impact, and about the protecting the past performance. So I don't think that at being the you can call me personally and our team as a bit of a risk with very high risk appetite. We are ready to take the risk for the high returns. Okay, so we don't want to protect our returns and sit आराम से कि ठीक है यार CAGR बहुत अच्छा आ गया थोड़ा नीचे जाएगा तो चलेगा. We will take some calls based on the requirement. To us, what is our belief system is that if we are continue to do what we were doing since last 10 years, okay, and we will see the same results, which is phenomenal. Like 22% CAGR with 8 times of money. So that is phenomenal, and the same philosophy, thought process of selecting the company, remaining invested, that we are following. Now coming to the first question of inflation. Okay, so yes, there will be impacted figures in Q2 till Q2 of FY23. But I feel that as a long-term player, you will have to ignore this kind of situation. Um, One, market is already discounted. All the companies are down, I think, around 20% from their peak. Around 20%, maybe more or less, but majority of the companies. So I think that sharp decrease is already discounted. Uh, in next few months, say probably April, May, everyone will start discounting FY24, okay, earnings, which again will give a very rosy picture. So I don't think that having this 2 3 months, 2 3 quarters time frame in mind, we can take any decision. Even in the worst case scenario, I was reading one quote, famous quote from the Warren Buffett, that he said even if World War III happens or nuclear war happens, it is better to remain invested. If you are invested, if it happens, then of course you don't need money. And if it doesn't happen, then you will make big money. Okay, so we will have to ignore. Of course, financials will be impacted, but we will have to remain invested.
Arpit, and we are running out of time, and still I'll take the last question, which is I found very interesting. This is from Chandrasekhar V. He is asking, sir, even though the small cap companies have begun their journey towards transparency, most small cap companies in India are still a proprietorship in the public company forum. There is no transparency, is what Mr. Chandrasekhar feels. What is your input to Chandrasekhar when he is saying that still he feels small cap companies are not transparent yet?
Can I answer?
See, I beg to differ. He may be cases in his mind, maybe into some from micro cap companies or maybe very penny stock. Majority of the companies with larger volumes, okay, we in all our portfolio companies there is a certainly barring I think one or two companies, all the companies. So 18 companies out of these 20 are run by the professionals. Okay, so and that's where you will need a fund manager, even if it is run by the promoter, whether promoters are bankable or no, or even if it is run by the professional, whether it is bankable or no. Okay, what is the credential of the manager? Okay, that we have to keep in mind.
So you are saying your portfolio company doesn't face these problems of transparency is what you are trying to say, correct?
Yeah.
So just to add a point, like there are, as he initially pointed out, 4,750 plus companies. Okay, and if you are not getting a comfort with the management, answer is simple: don't invest. Okay, identify the companies where there is a transparency. Okay, so there are enough opportunities. Okay, and one where you are not getting a comfort. Okay, as Arpit has pointed out, we will also not invest. Okay, if we are not convinced. Okay, same way Mr. Chandrasekhar also should skip those companies where there is a discomfort.
Sure. And I definitely want to thank all the investors, both PTM and PMS Bazaar investors. And I want to thank Arpit and Vishal for a wonderful session. I would like to thank all of you. Thank you.
Yeah, thank you from Care PMS also. Thanks to entire team of PMS Bazaar and particularly Mr. Sivaram Rajan. Thank you very much for this opportunity. Thank you.
Thank you.
Thank you everyone for participating. Thanks PMS Bazaar.
Thanks Vishal and Arpit. Thank you.